There's a 27-year-old right now putting $200 a month into something that will be worth less in 30 years than if he just bought a used Toyota and let it rust in his driveway, and he thinks he's investing wisely. Here's the thing nobody wants to say out loud. Most people destroy their wealth not by doing nothing, but by doing exactly what sounds smart. The advice changes, the decade changes, but the pattern of well-meaning financial suicide stays perfectly consistent. This is about the investments you need to avoid and the uncomfortable truth about what actually works, depending on when you were born. Let's start in your 20s, because that's where the damage gets locked in. You're told to invest, to start early, to let compound interest do the heavy lifting. All of this is correct, but then comes the part where it goes wrong. The median 25-year-old today has about $2,000 saved. They open a brokerage account. They see 100 different funds. They freeze. Then they see something called a growth opportunity or disruptive innovation fund, and it feels right. It feels like betting on the future. Here's what that actually means. You're buying companies with no profits, sky-high valuations, and a story that sounds like a TED Talk. You're paying a 1% annual fee to a manager who's essentially buying lottery tickets with your retirement. From 2000 to 2002, the average aggressive growth fund lost 63%. Not $63, 63% of everything. The math is cruel. If you lose 50%, you need 100% gain just to break even. Most of those funds never recovered. So what should you actually do in your 20s? Boring index funds, total market, S&P 500, the stuff that makes no one at a dinner party interested in your investment strategy. Why? Because in your 20s, you have one asset no other decade gets: time to recover from a crash. The 2008 financial crisis destroyed people in their 50s. It was a buying opportunity for people in their 20s. But here's the trap inside the trap. Time doesn't just mean you can take risks. It means you should be ruthlessly efficient with fees. A 1% annual fee doesn't sound like much. Over 40 years, it will cost you around 30% of your total portfolio value. You're in your 20s. You should be maxing out a Roth IRA with low-cost index funds, contributing enough to your 401k to get the employer match, and ignoring literally everything else the financial industry tries to sell you. No stock picking, no crypto as a core holding, no investment apps that gamify your financial future like a slot machine. The goal isn't to get rich quick, it's to not be poor slowly. Your 30s are different. You probably have more money now, maybe a family, definitely more pressure, and that's when the real estate bug bites. Everyone around you is buying. Your parents ask when you're going to stop throwing away money on rent. You see Instagram posts of friends with keys to their first home. The cultural pressure is immense, so you buy a house you can technically afford, which usually means a house that costs about 4 times your household income with a 30-year mortgage at whatever rate you can get. Here's what they don't tell you. A primary residence is not an investment. It's a place to live that happens to hold value, maybe. From 1890 to 2004, U.S. housing prices increased on average less than 1% per year after inflation. You know what did better? Stocks. By a lot. And that's before you factor in property taxes, maintenance, insurance, and the opportunity cost of the down payment you just locked into an illiquid asset. But people don't feel that. They feel the comfort of ownership. They feel like they're building equity. And sometimes, depending on the market and timing, they're right. The mistake isn't buying a house. The mistake is buying too much house and calling it an investment strategy. If you're in your 30s, the wealth building move is this. Buy a home you can afford on one income if you're a couple, or on 70% of your income if you're single. Then, keep investing heavily in index funds, not rental properties, not house flipping, not a vacation home you'll Airbnb to cover the mortgage. Because here's the thing about real estate beyond your primary residence. It's a second job pretending to be passive income. Tenants break things, markets turn, taxes rise, regulations change, and the math rarely works the way the seminar promised. The average landlord makes about 6% annual return. The S&P 500 averaged about 10% over the last 50 years. You're taking on more risk, more work, and more leverage for lower returns. Unless you're in the business of real estate, treating it like a business, this is a trap. Now, your 40s. This is the decade where everything gets expensive and everyone gets desperate. Kids are heading toward college. Retirement is visible on the horizon, but not close enough to feel safe, and your portfolio probably isn't where you thought it would be. So you start looking for shortcuts. You hear about a friend who made 40% in some alternative investment. You see ads for private equity funds, hedge funds, structured notes, annuities that promise guaranteed income. All of this sounds sophisticated. Most of it is just expensive. Hedge funds, on average, have underperformed the S&P 500 for the last 15 years. They charge 2% management fees plus 20% of profits. You're paying someone to lose to an index fund you could buy for 0.03%. Annuities are even worse. They're insurance products disguised as investments with surrender charges that lock you in, fees buried in fine print, and returns that rarely beat inflation after costs. But they're sold hard because the commissions are enormous. Here's the irony. The decade you feel the most pressure to catch up is the decade you're most vulnerable to predatory financial products. What actually works in your 40s? Discipline. Increasing your savings rate, not chasing yield. If you're behind, the answer isn't a riskier investment. It's spending less and saving more. It's refinancing your mortgage if rates dropped. It's killing debt, especially high-interest credit cards. And it's resisting the urge to panic optimize. People in their 40s love to diversify into things they don't understand because it feels proactive. Gold, commodities, foreign bonds, cryptocurrency. But diversification doesn't mean owning everything. It means owning assets that don't move together. A total market index fund already gives you that. You own thousands of companies across every sector. The mistake is confusing activity with progress. Trading feels like you're doing something. Rebalancing once a year and otherwise leaving it alone feels like you're doing nothing. But nothing is usually the right move. The best investors aren't the ones who do the most. They're the ones who do the least at the right time, your 50s. This is the final sprint before retirement, and the margin for error is gone. You can't recover from a bad investment the way you could at 30. A market crash 2 years before you retire can cut your retirement income in half. So this is the decade you're supposed to get conservative. Bonds, cash, lower risk. And that's mostly right. Except bonds aren't what they used to be. For decades, the standard advice was a 60-40 portfolio. 60% stocks, 40% bonds. The bonds were your safety net. When stocks crashed, bonds held steady or went up. But since 2022, we've seen something weird. Stocks and bonds fell at the same time. The correlation broke, and bond yields, after years near zero, finally rose, which sounds good until you realize rising yields mean existing bonds lose value. If you bought a 10-year treasury in 2020 yielding 1% and rates went to 4%, your bond lost about 25% of its value. So what do you do in your 50s? You still need growth, because you might live another 40 years, but you can't afford a total wipeout. The answer isn't sexy, it's a gradual shift. Not from stocks to bonds overnight, but from 100% stocks to maybe 70 or 80%. Keep some cash for emergencies, keep some short-term bonds or a high-yield savings account, and whatever you do, don't try to time the market. This is the decade where people get scared and pull everything out after a crash, locking in losses, or they get greedy and go all in on something speculative because they feel like it's their last chance. Both are catastrophic. The people who retire comfortably aren't the ones who made brilliant trades. They're the ones who contributed consistently, kept fees low, stayed invested through crashes, and didn't do anything stupid. That's it. That's the whole strategy. No secret hedge fund, no real estate empire, no day trading, just boring, compounding, low-cost index funds and the discipline to leave them alone. Here's the part no one wants to hear. You will be tempted in every decade to do something clever, to outsmart the market, to find the edge everyone else missed, and almost every time, you will be wrong. The financial industry makes billions selling you complexity. The truth is simple, and it's been the same for 50 years. Start early, invest consistently, keep costs low, ignore the noise. The real question isn't what to invest in. It's whether you can resist everything designed to pull you away from what works.